Vice Chancellor, thank you very, very much for your very kind introduction. I said this yesterday, but when you ramble on about my introduction, it gives the impression to everyone that I cannot hold a job. I've been in too many different places, but you have to appreciate that I graduated from law school. I was your age in 1974. That's when I graduated from law school. And so it's been a few years that I've been engaged in these activities. But when you say it like that and I hear it, it sounds like it can't stay in one place. I've been very, very lucky that I've been able to experience many different things around the world. I also want to thank the Vice Chancellor for asking me to participate in the seminar, the conference yesterday in New Delhi on IP. It had a very, very interesting title, which is Innovation for Shared Prosperity. And then the subtitle was Past Tense, Present Perplexed, and Future Perfect. And if you think about that's a very aspirational sort of thought, shared prosperity. It also talks about the fact that our past have also had difficulties and have had tension in them. Our presence, we never know where we are at the present time, but we have to be hopeful about the future, so hopefully future perfect. So I also want to thank the people that I've met today, and I've met students and have had the chance to speak with students one-on-one. I've introduced myself to them, and they've told me what they were studying. I've also had the opportunity to take a tour of the campus at your various facilities around the place, ranging from the swimming pool. I threatened Raj that I would come back to his office and I would need a towel, but I refrained. I did not jump in the swimming pool. It was quite hot, but I did not jump in the swimming pool. But I had the privilege of talking with people, both on the faculty, the law faculty, as well as the director of student housing and so forth. And I have to say that the impression that I got from talking with each of these individuals is how proud they are to be a part of this university. And it is almost contagious. It's extraordinarily impressive, and I think to have done what you have done, Vice Chancellor, and your colleagues and your friends and colleagues here is simply remarkable. It is to see the amount of progress that you've accomplished, to see the enthusiasm, to see the rate of growth that is continuing is inspiring. So thank you for asking me to your campus. Thank you for allowing me to be here. And now what I plan to do is talk about my area of work for the last 20 or so years of my life. And I just want to give you a quick overview of what I'm going to be talking about. First, I'm going to talk a little bit about my background and how I got into investment banking. The Vice Chancellor has very kindly given an introduction, but I'm going to describe it from my perspective and say why and how I got into investment banking. I'm going to then describe to you what I understood at the time to be investment banking and what I learned investment banking actually is, and to differentiate an investment bank from a regular commercial bank or retail bank, so we have that perspective. I'll then turn to the past of investment banking and give a very, very quick, broad brush of investment banking as it developed through the centuries. And I mean broad brush. That'll be hundreds of years in 2 minutes. And I'll talk a bit about Goldman Sachs in India. I had the privilege of working on the joint venture with Uday Kotak in 1996 when Goldman Sachs and Kotak Mahindra formed a joint venture. And so I'll be talking about that and how we separated in 2006 and how we're doing similar but different things these days. And I should stop using the term we because I am no longer with Goldman Sachs. I don't know about you, but I find myself we are all a composite of our past identities. And so if you talk about a particular time, I become that time and person again. So when I say we, I'm talking about Goldman Sachs rather than being a part of Goldman Sachs now. I'll then touch on the 2007-2008 financial crisis, the Great Recession, and the regulations that were brought there. I will then turn to the present, talk about some transactions that have been done in India by Goldman Sachs, and then try to peek into the future to the extent anyone can do that. So that's my plan, and then I'd be happy to answer questions if they're easy questions. Difficult questions I might not be able to answer. A little bit about myself. I was born in a small town in South Carolina, a farming community, Florence, South Carolina. Now, I'm not going to take you all the way through, but just to tell you that's where I started. I went to high school in South Carolina. It's one of the states that's a heavily Republican state these days. It's still in large measure a rural community. It is a farming area. It's one of the 13 original colonies, but nonetheless, it is one of the poorer sections of the country, and it has the great distinction, that's the wrong word, it has the terrible distinction of being ranked 50th in all the states of the 50 states in terms of education in the United States. And so that's where I'm from. That's where I was educated. I'm just making that point to be clear about to just reiterate what I touched on in the very beginning, the importance of education and the wonderful things that are going on here at O.P. Jindal Global University, and the hope and the growth that you have here, because education is the foundation for the future. After going through my high school years in South Carolina, I went to university, and then, as Raj explained, I joined the U.S. federal government, and I became a trial attorney for the U.S. Department of Justice. And there, the U.S. Department of Justice defends the tax authority. When taxpayers sue the IRS, the Internal Revenue Service, the lawyers that defend the Internal Revenue Service in U.S. district courts are lawyers from the Justice Department. And so I was a trial attorney for the Justice Department, and then was fortunate that I moved to the Ways and Means Committee staff. Under the U.S. Constitution, the House of Representatives is constitutionally charged to have all revenue tax measures originate in the House, and so the Ways and Means Committee is where tax legislation is generated. I then joined Exxon, which is an oil and gas firm, as you know. That was before it was merged with Mobil, and I came to Asia to head up the tax function in Hong Kong for the Asia region, and had the good fortune of being able to then, for the very first time, come to India, given a tax dispute that the Indian tax authorities caused. And so I've had the good fortune of being able to come to India from I guess it was the late, from 1984 onwards. After that, I then joined a global law firm and was able to practice law, practicing tax law. And at that stage, Goldman Sachs, you know, the world investment bank, which at that time in 1994 when I joined them had about 3,400 people in the bank, and at that time was a private partnership, contacted me and asked if I wanted to work for them in Asia. And I had no idea really what Goldman Sachs was about or what an investment bank is about. I just heard the word bank, and I thought that they were like just any other bank. You put deposits there, and sometimes you're able to take a loan for a mortgage or a car or some sort of asset acquisition. But I learned otherwise. And so when I joined Goldman Sachs, I had no real idea what investment banking is about. So what I'd like to do now is tell you that over those 20 plus years that I was with Goldman Sachs, I have come to a better understanding of what a bank does. Now you may be asking, why does someone in the tax department, why would they have the ability to tell you about an investment bank? Because I'm not, and I've never been an investment banker per se, but being a part of the tax department, we had to make the arrangements in order to have the appropriate corporate structures in countries where we do business. So that means, for example, in India, to help establish the joint ventures through which the businesses would be undertaken. So that was done throughout the region because we were expanding in some way of feeling of the way that Jindal is expanding so rapidly. Goldman Sachs, from the time I joined in 1994 through 2017, expanded in this region extraordinarily quickly, establishing offices throughout the region, increasing its headcount a great deal. So being in the tax department, I was engaged in each of those transactions in order to either acquire something or to merge with something or to set up something from the beginning. And also in the tax department, you are responsible for making sure that you comply with the tax laws, which means filing timely tax returns and so forth. And to do that, you need to know the overall business of the firm so that you can translate what's on the financial statements into taxable income that's reported on the tax returns. And then you have to be able to defend your positions to tax auditors when they audit you, because it is inevitable. A firm with the name of Goldman Sachs, the size of Goldman Sachs, the transactions that Goldman Sachs undertakes that will be audited. We are audited, Goldman Sachs is audited on a continual basis in the United States, and it is audited by every jurisdiction in which we do business. And those audits do rather frequently throw up disagreements because the tax authorities see the tax law one way, and when we file our tax returns, we might see it a different way. And of course, we're trying to comply with the laws, but because there are two different views, that creates disputes. And so as being the person in charge of the the Asia Pacific tax function, had to be able to defend these positions with the authorities, and also then in courts, and then subsequently with governments and double taxation disputes. And so I had a very fortunate view of what happened at Goldman Sachs, and so that's why I can now tell you why an investment bank and how an investment bank is different from a commercial bank. Now, if you think of a commercial bank, sometimes called a retail bank, it typically takes cash deposits from banking customers. It takes money in, and then it lends to businesses and individuals. These can be home mortgages, car loans, business loans. They can be secured or unsecured loans. And generally speaking, and I'm sure a commercial bank will take a bit of disagreement with me on this, but generally speaking, the retail banking strategy is relatively straightforward. It's basically to give away less on deposit rates to your depositors and receive more from your borrowers. It's playing the difference between the deposit rates and the lending rates. It's a straightforward, reasonably straightforward business. Now, everything has its own set of complications, but it's also a relatively safe business, and the profit margins with respect to a commercial or retail bank are typically lower, or historically have been typically lower than investment banks. Now, investment banks have more risk. They are a higher margin business. And so I'm now going to briefly describe in sort of large category types the type of businesses that investment banks engage in that commercial banks, that are pure commercial banks, do not engage with. Now, I pause here to make one statement. A number of the very big banks today are what I would call universal banks. they are both commercial banks and have investment banks as well. And so they have aspects of both of these. But when I joined Goldman Sachs back in 1994, when Goldman Sachs was a private partnership, it was at that time what people would say was an investment bank. And at that time, there were sort of 5 broad categories of businesses that investment banks engaged in that were not engaged in by commercial banks. And they include proprietary trading, also known in shorthand as prop trading. Proprietary trading is where an investment bank uses its own funds, puts its own funds at risk, and the trading is you make money out of just trading your own money. And after the Great Recession in 2008, substantial restrictions were put on, at least in the United States, and these rules were replicated elsewhere outside the United States, on proprietary trading. So much less of the activities of investment banks these days will be proprietary trading because it could be seen that you would be investing money that you could lose that without adequate capital reserves, and you could cause great systemic risk in the economy. But nonetheless, proprietary trading, namely trading your own funds to earn higher margin investment returns, was something that investment banks did, and to some degree still do, and countries where they don't have these restrictions still continue. In addition, another area of investment banking is market making in securities traded on exchanges. And now I'm going to be sounding a little technical, I guess, but it's akin to a car dealer. You know, a car dealer has a inventory of automobiles, and so they're making a market in the cars that they own. Now, it's a little different with something on the exchange, because the exchange itself is there because it guarantees both sides of the trade. An exchange guarantees to the seller that the buyer will perform, will pay, and the exchange guarantees to the seller the other way around. And so market making in securities with banks is that the investment banks stand ready to be on the other side of a trade. And it is an extraordinarily valuable function that investment banks perform in securities market, because it allows these markets to be liquid. And if you had markets that were not liquid, you would have very choppy movements in the transactions, and it would be a very awkward sort of thing. And so market making by firms, by investment banks, glide that movement to a degree, and investment banks generate income from being market makers on security exchanges. Now, investment banks also couple these activities with security broking activities, meaning that if you want to buy a share of any company that's traded on an exchange, you would not go to the exchange and try to buy the share. You would go to a broker who would execute the transaction on your behalf, and generally take a commission, or if it has it in inventory, would actually take a margin instead of a commission. But these activities all together, trading on the exchange, being a market maker on the exchange, being able to take commissions on the broking activities from securities traded on exchanges, is another very significant, a second significant part of what investment banks do. Another activity that investment banks are engaged in is the merger and M&A advisory work, mergers and acquisition advisory work. If a predator company wants to buy or merge with a target company, if you were talking about large transactions, they typically will go to an investment bank and ask advice on the deal. You know, how to structure the deal. Should the predator use cash? Should it be a cash deal? Should they use their own stock as the way to buy the other company? Should they incur debt? Investment banks also engage in due diligence of the target company. And these advisory activities generate fees that are generally based on the size of the transaction. And so you know from just seeing the news, I mean, you see huge numbers when big companies merge with each other or take over each other. So investment banks are typically engaged in helping structure those deals and do the due diligence in those deals and get a percentage of the arrangements. And so depending on the size of the deal, these activities can be extraordinarily profitable given its percentage of a large number. Now, so that's the third category of investment banking. The fourth category is something that I sort of knew a little bit about by being a lawyer, but didn't really appreciate it all that well. Companies can raise money either by borrowing it or selling equity. And if you want to do that on a public market, as opposed to just doing it to your friends, borrowing from your friends or selling shares to your family member, if you're going to undertake a public listing of shares, an initial public offering or something like that, you will get an investment bank involved to raise the capital for that. So you will have a firm that needs to raise money will go to an investment bank, and then the determination will need to be made, should this capital be raised in equity? Is that the best way we could go? Or should we raise debt? And by raising debt, that is a different sort of ongoing obligation that the company has with the debt holder versus the shareholder, the equity holder. So that has to be discussed. Which exchange should we list on? How are we going to list? We need to publicize this transaction. So the investment bank is involved in terms of preparing prospectuses and other items in order to, in effect, sell the deal to investors. And so these capital raising activities, whether debt or equity, are involved in publicizing the transaction, meeting with investors, and trying to sell the deal, basically. Now, you can have situations in this capital raising situation where investment banks will agree with the issuer that the investment bank will underwrite the whole deal, meaning that the investment bank will take onto its books this liability to then on-sell the securities or the debt to investors. And so you have that aspect as well. There's more risk involved when the investment bank takes onto its own books and completely underwrites the transaction. And so that's the fourth category of transactions at different investment banks. The fifth one is a corporate and financial structuring. Companies come in and ask for advice on how they can best perhaps situate their financial statements. So, for example, it could be something as straightforward as a swap, where one company that has a floating interest rate on debt in one currency would prefer to have a fixed interest rate on another currency. And so there can be swaps involved in order that the company would have a liability in a foreign currency that it desires in a fixed rate as opposed to the foreign currency it does not desire at a floating rate. Now, changing that arrangement and making sure that it works will generate fees for an investment bank, and these fees can be substantial. So that's the way investment banks are different to commercial banks. And as I said, we have some very big banks around now that combine both of these, and so they have both, and they're typically referred to as universal banks. I'd like to now just very quickly touch on the history of investment banking. The most most of the oldest investment banks originated as merchants. I'm talking a long time ago when they traded in commodities, spices, grains, silks, metals, and so on their own account. Now, as they got larger, these institutions, or these firms, they weren't institutions at the time, merchant banks would lend money to a range of monarchs and royalty, including the papacy in Rome. They would gain privileges, so forth, access and side payments in return. And famous examples of this are the Medicis in Florence in the late 15th and the 14th and the 15th centuries. Barings in 1763. Rothschilds later in the 18th century. And then you can have a long list of names that are recognizable but are fading from history a bit. Schroders, Kleinwort, Morgan, now Morgan Stanley, and so forth. So full-fledged investment banking based on underwriting and placement of corporate securities, those activities gained in number in parallel with the liberalization of the incorporation and the onset of large-scale corporations that needed external finance. And so you needed to have, for these activities to develop, you had to have the law that permitted corporations to exist. And as you probably know, corporations many, many years ago were one-off deals. That was well before the Companies Acts in various jurisdictions, which allow you to incorporate companies rather quickly. But before, you had to have special arrangements with the legislatures, with the kings and so forth, in order to establish corporations. So something like something well known in India, the East India companies and so forth were not modern corporations. They were established under the old rules. And so what happened these days, I mean, the underwriting happened at the same time in parallel with the activities of the development of the law that permitted corporations to exist rather quickly. Now, moving much more forward in time, in the United States, famously split investment banking and commercial banking under the so-called Glass-Steagall Act of 1933. And they did that because that was a reaction to the Great Depression in 1929. And some pointed out that banks would dupe investors and convert their bad loans into equity and then sell equity shares and pawn those off to customers, because they were doing both things. They were lending and they were engaged in securities underwriting and securities business. And so in the United States, those activities after the Great Depression were split into two. This sort of leads me to the realization or the observation that it's that old statement that generals typically fight the last war. They don't necessarily fight the war that they should be fighting or the future war, but we fight the last war. So the Glass-Steagall Act is an example of a reaction to the Great Depression. And today we see the reaction to the Great Recession in the United States with the Dodd-Frank legislation. And Dodd-Frank did a number of things which I will touch on. Firstly, it put limits on the proprietary trading that I mentioned toward the beginning of this discussion. Investment banks can no longer, at least in the United States, and their subsidiaries and so forth, cannot engage in proprietary trading. And that takes away one of the large, higher margin, higher risk activities that investment banks used to deal with. In addition, Dodd-Frank also added substantial regulatory capital reserve requirements on banks, so that banks have to have more, especially systemically important banks, have to have more capital on their balance sheets to protect against downturns. And capital on your balance sheet is an expensive item to have. It's capital, not something else. In addition, Dodd-Frank also put limitations on investment banks owning private equity funds and hedge funds. When I was at Goldman Sachs, some of the big business that we would do was engage in private equity funds that we would offer funds to investors and in turn invest Goldman Sachs' own money, 20, 30, 40% of the fund, together with investors and invest in private equity, and then make returns both to the third-party investors as well as Goldman Sachs. Those private equity funds and the hedge funds and there ends my lecture. Thank you for your attention. Actually, I'm not finished, but if you'd like me to be finished, I can be. So I'll just continue. It's kind of interesting when the lights are turned off, but I hope I can see what I've written in my notes. Now, these regulations, this Dodd-Frank Act actually has an adverse effect on investment banks' profit. I mean, if you're just looking at this from being an investment bank, you don't like these regulations because it restricts what you can do. If you are an investor or someone in the public that worry about the instability of investment banks and the fact that big banks can't be broken up and that sort of thing, you probably like these kind of rules. But from the perspective of an investment bank, these sorts of restrictions make your business a bit lower margin a business with more capital requirements. And so investment banking has changed dramatically in response to the Great Recession by virtue of these limitations that are placed on it. But before I get, so that's where we are sort of now. But before I get into the future, I want to touch on briefly Goldman Sachs in India, because it has a very interesting history, I think. In 1996, a joint venture with Uday Kotak, and as I mentioned, that was known at the time, and still there's Kotak Mahindra company. At that time, had a joint venture with Kotak Mahindra Finance Limited. And I was very privileged to be in a couple of meetings with Mr. Kotak, with Uday. He is a very, I have to say, a very smart, very quick, very insightful person that can make judgments very, very well and can take a vast amount of data and capsulize it very, very, focus it very, very clearly. So I had a great deal of respect for his financial acumen as well as his just intellect. Now that joint venture ran primarily out of Mumbai, and in 2006 we separated. It was a bit of like a divorce of sorts. He bought 25% that we held in some of those companies, and so he has in turn created a universal bank, a very large, very profitable universal bank here in India. And we, in 2006, also undertook our own investment banking activities here. And we've been Goldman Sachs has been an active investor in India since 2006. It's invested more than $3.6 billion in capital since 2006. The firm has advised on a number of major M&As in India. Flipkart's $17 billion sale to Walmart, which was the largest ever merger and acquisition activity in India. Daiichi Sanyo's $3.2 billion stake sale of Sun Pharmaceuticals in 2015. I remember that that block sale trade very well. These transactions, when they happen, can be like a number of things. Probably like when you're studying for exams, they become the focus of one's life. Just almost 24 hours a day. A lot of tension, a lot of activity, a lot of things can go wrong. A lot of calls, a lot of stress. But at the same time, you have these transformations of the industrial scene as a consequence. Another activity was ICICI Bank's $5 billion follow-on offering in 2007, and it was the largest follow-on offering in India. And by what I mean by that, it's another underwriting, but it's following on an initial one. So I mean, it's another one so it's not the first one. The other thing that I would like to say is that before I cannot leave Goldman Sachs, the topic of Goldman Sachs in India, without mentioning two more things. One is, I don't know if any of you know this, maybe some of you do, but I had the privilege of meeting your Vice Chancellor's wife in Mumbai, because she was General Counsel for Goldman Sachs in India. And Goldman Sachs was extraordinarily lucky to have her working with us at that time, and she's now a distinguished lawyer here in India. And so that's one thing I need to mention. The other thing that I should mention is also that Goldman Sachs has a very, very large presence in Bengaluru. We have 5,000 people thereabout in Bangalore, and have made a $250 million construction on our campus in Bangalore, which undertakes activities that assist global activities around the world, whether it's controllers' activities, whether it's investment bank backup research, whether it's operational, whether it's compliance. There are a number of activities that are done in Bangalore that are not now done elsewhere because of the good work of people in Bangalore. So I've now talked about how I got into investment banking, what I understood investment banking to be when I joined, which was not much, and how I understand it to be now, which is a little bit more, and how it's changed. It's changed in large measure because of the regulatory requirements, because after all, this is a regulated industry. But now I'd like to sort of try to take a peek at what the future might hold for investment banks generally, but focus a little bit more on Goldman Sachs. Some of you may have, I was talking this afternoon with someone about how language changes all the time. The language we speak today is not the language that was spoken 100 years ago. We use slang that would never be used. We use language as an evolving thing. Likewise, an investment bank is an evolving sort of situation. What it was before, it will change. Either businesses will no longer be there, or they will be regulated out of business. New opportunities will be found. And so in the case of Goldman Sachs, some of you may have seen that Goldman Sachs is now venturing into the credit card business with Apple, and they've got a very nice looking credit card, titanium card or something like that. I don't have one yet, but I probably will get one since I have an Apple phone. And I am still a loyal Goldman Sachs person. So Goldman Sachs is getting into the credit card business, which means that my comments are almost over. So it's getting to be more like what banks do. I mean, a lot of American Express, MasterCard, a lot of institutions offer credit cards. And so Goldman Sachs, instead of being this white shoe sort of investment bank, is now getting involved in credit card business. It is also, because of these regulations, because of the Dodd-Frank regulations, registered to become a bank. It did that in 2008 in order to have access to the Fed's window, meaning that it can borrow directly from the U.S. government at lower rates than financing things away from the government. And so it is transforming itself from what was a traditional investment bank into something that is more like a universal bank, especially given the fact that it's also introduced this line of business called Marcus, which will allow small depositors to deposit into Goldman Sachs and earn interest rates on their deposits, something that Goldman Sachs did not do in the past. In the past, when I joined Goldman Sachs, in order to have an account with Goldman Sachs, an investor would have to have a minimum of a $10 million free money to invest. So not money that's sort of tied to family homes or something, but actual free money that they could invest. And so now Goldman Sachs takes small investments with Marcus. So that's changed. And so the future is that investment banking is going to be as it was. If you took a look around 5 years ago to what it is, I shouldn't say 5 years ago. If you looked around 20 years ago to what it is today, it is much less profitable than it was before. And it is growing, trying to find revenue sources from other places. And this is a consequence of the increased capital requirements, the increased regulatory requirements, and the elimination of proprietary trading. So in addition to becoming more like a retail bank or becoming a universal bank, I think the other things that we need to talk about if we try to devise what the future is, we need to think about just two things. One is regulation. We're going to be seeing more regulatory reforms on banking, especially in the United States. And we also have to remember technology. And I think your university's conference yesterday was quite prescient in all of that. IP transfers and so forth, the technology that is involved, because technology is perhaps the greatest single factor that is going to impact investment banking. There are a couple of key areas that we should look at here. One is digitalization through AI. Another is big data. Another is mobile technologies. Another are interactive platforms. You probably have seen things about that. And then the last thing I'd like to mention is just blockchain. Blockchain has the potential to act as a new type of middleman, except unlike a bank, which is an actual entity, and blockchain is a technology. And this type of technology will ideally, at least from the customer's perspective, reduce commissions. It will increase the speed of transactions and dramatically enhance the security of the transaction, eliminating fraud. So blockchain is something that is being studied very, very carefully by banks and investment banks. And I'd like to say that Goldman Sachs is now hiring, and it's not hiring traditional bankers. It's hiring technology people. If you look at the makeup of the total number of employees of Goldman Sachs, as I said, when I joined, it was about, 3,000, 4,000 people. Now there are about 30,000 people. 20%, 25% of those people are in technology. And the people that are being hired now are technologists. And they're not being just hired to be in the IT department. They're being hired to be in the Securities division. And so technology is going to be the future of investment banking. It's going to change a great deal. Now, I think I've ideally spoken for exactly 1 hour, so there's no time for questions. I'm finished. Thank you for your attention. I appreciate it. I'd be happy to answer questions.